Dicky here. I wanted to give an update on what I think is going to happen this week with the Fed. And I was listening to this video, and he had a couple of really good points that I wanted to discuss and a couple counterpoints. And I was making a list of things I wanted to go over, and he touched on most of them. So I thought I would start with his video and give you my opinion on where I think things are going to go and where I think he's got it right and where I think he may have it wrong, or at least my interpretation of it. So let's listen to this video, and I'll give you my thoughts along the way.
This Wednesday is going to be a big day because on Wednesday, that's the Federal Reserve FOMC meeting. And at their meeting, they will decide whether to raise interest rates or not. On Wednesday, I believe that they're not going to raise interest rates. And that is the overwhelming market opinion. There's a 98% chance that the Federal Reserve does not raise rates on Wednesday. However,
Now, I agree with his assessment here, and not just him, but most everyone, clearly 98% think that they're not going to raise. What's interesting to me about that is that when you look at the reasons why, I don't think they make any sense. And the reason I say that is I think it was a foregone conclusion that they weren't going to raise here. I heard an analyst a few weeks back say the same thing I'm going to say now, and that is that I think the intention was that no matter what happened, they were going to raise, pause, raise, pause, raise. That was the intention here. And regardless of data. So even though they said they were going to be data dependent, they were going to do that. Because if you look at the actual data, I don't know that it actually supports not raising if they really think that inflation's coming back. And that really becomes the issue. And like I say, I wrote down a couple of notes here, but let's finish with what he's got on the video because, again, I think there's some really good points that he makes here.
they could be planning to raise rates at future meetings. So I'm talking about the November meeting and or the December meeting. So I'm going to update you on the situation and then I'm going to give you my opinion. So let's get started. So here's the situation. The Federal Reserve is raising interest rates to fight inflation. But the thing is that there's a trade-off. If you raise interest rates, it lowers inflation, but it also hurts the economy.
Okay, and I want to stop it here. This is the old school look of it, and it's not him that's doing this. It has been in the anticipation or the interpretation of the majority of economists and even the Fed. If you listen to their speak, they sit back and say that, hey, if we raise interest rates, it should raise unemployment, which should by default make people scared about their jobs and cause them to spend less money, thus lowering inflation. That was the old model and theory. The problem is that none of that has worked in this particular scenario. And I think part of the problem that no one is taking into consideration, we're using old models when it comes to a new world scenario. We created this. This is not a scenario of the 70s where we had a market that kind of went out of whack and got out of control. We shut the world down. We screwed up the entire economy of the world by doing what we did. And we haven't recovered from it. We haven't gotten things back to where it's supposed to be yet. And yet we think that the old models are actually going to fit the current world. And it just doesn't make any sense to me. It hasn't from the beginning. When you cause what we did and spend the money that we spent, it just doesn't make sense that we're going to be able to fix it the way we fixed other things. The first case in point, every meeting, Powell has come out and said, we expect unemployment to go up to 4.5, 4.6. And again, we're still between 3.5 and 3.8% in unemployment. It's done literally nothing in almost 2 years. Granted, he didn't start raising it, but he said he was going to start raising it in November of 21. So we're not too far off of when he said he was going to start raising things. And yet nothing has happened on the unemployment side. So I really question whether or not what used to work is going to work going forward, which again, let's just deal with reality. And the reality is it's not working in that way.
So the dilemma is that if you raise interest rates too high, then it's going to cause a recession. And I understand, I acknowledge that people are saying, or they're going to say, Brian, we're already in a recession. So I'm not going to argue with that. But essentially, if you raise rates too high, it's going to cause a recession.
Okay, I want to stop here because I think the recession is the least of our concerns. What my concern about raising interest rates too high, and those of you who've seen my other videos, you'll notice when I said this before, interest rates being where they're at was where they were at throughout the whole 90s. So I'm not concerned about business handling it at this point. I'm not concerned about the economy handling it because the economy did just fine in the 90s. My concern is that typically speaking, if you get interest rates too high, what are you breaking that you don't know about? Are you breaking businesses? Are you, again, forget the recession part. What are we break that is not on our radar? And that's the bigger concern for me. What if it's just like the banking scenario earlier this year? Like I think it was a debacle, not what it was, but what if it really becomes a problem? What if it becomes systemic or a bigger issue? And again, maybe it's not the banking department. Maybe it's a different division altogether. Maybe there's a different section of the economy that becomes a problem because we're raising rates, especially if rates are not affecting unemployment and are not affecting inflation, which I don't think they are.
And if you don't raise rates high enough, then it's gonna encourage inflation to stay high. So the Federal Reserve is trying to find that interest rate sweet spots where inflation comes down, but we avoid a recession. In the past year and a half, the Federal Reserve has raised interest rates 11 times. The federal funds interest rate right now, it's at 5.5%, and that is a 22-year high. So it's definitely not low. Okay, so we're currently at 5.5%. That's the Fed funds rate. Some of the Federal Reserve officials are saying that 5.5%, where we're currently at, is the sweet spot that we don't.
Okay. Now, some of my other videos I've explained this, and I'll continue to try to explain it here because it is coming up. One of the first times since the Fed started raising rates, not quite 2 years ago, a year and a half ago, or whenever they started, but when he said he was going to start it in November of 21, we're starting to see some dissension in the ranks of the different Fed seats. And they've been lockstep all along. And that's not necessarily a good thing. It's a far better thing to have some dissension, which means you actually have people having discussions and deciding whether this is a good thing or a bad thing to be raising rates and what's going on. If they're all just going in lockstep, then I'm always concerned about when everybody's doing exactly the same thing. So I like the fact that we have some dissension in the ranks. My question here, and this is to me the $1,000,000 or $1,000,000,000,000 question, if you want to say, it's not whether the 5.5 is the peak, or whether some of them think it's 5.75 or 6%. Does Powell say he needs to raise the terminal rate significantly? That's my question. And I've been saying this for months. If he says he's going to raise the terminal rate to say 6.75 or 7 or something like that, the market is not prepared for that. And that is really my biggest concern going into Wednesday.
Don't have to raise interest rates any higher. Other Federal Reserve officials are saying that the sweet spot is at 5.75%, and other Fed officials are saying that it's actually at 6.0%. So there's not 100% agreements between the Fed officials. On Wednesday, most likely the Federal Reserve will not raise interest rates. However, just because they don't raise on Wednesday, that doesn't mean that they're done for good in this economic cycle. So here's their mentality. If they raise interest rates too high, they can always cut interest rates.
Okay, now this is a concern for most of us that have been through these cycles before, is the going too far. And the question in my mind is, have they already gone too far? And I really think they have. And yes, he's right. They can lower them again. But if you really want to spook the market, do something they're not planning or they're not prepared for. And if the Fed all of a sudden raises it and then has to pivot and drop it real quick, that's a real good way to scare the market. Because even if you're lowering interest rates, that's going to freak out the market. And the reason it does is the question that most people will be saying if the Fed has to do that is, what are we missing? What have we missed? What do you see that we don't? That's the problem with overreaching on the inflation and going too high. That's the problem with going too high on interest rates. The problem with having interest rates go too high and going too far, yes, you can cut, but it ends up screwing up the market worse than if you didn't go in the first place.
So, yes, the economy would suffer more than necessary, but it would ensure or further ensure that inflation does not make a comeback.
And see, I don't agree with that. Just because you go too far on interest rates doesn't mean that you're going to stamp down inflation. And I'm sorry, the numbers right now do not favor that. Again, when we're raising interest rates, unemployment should be going up, inflation should be coming down because we're not spending. That's not the scenario here. Inflation is not coming down because we're not spending. Inflation is not coming down because of unemployment. Inflation is coming down because the general market is going that way. People are getting to the point where they're not going to pay any more for certain items. And again, part of that is the market, the businesses jack up their prices so much, not knowing where the end was going to be, realizing that they can always pull back if they need to, haven't really pulled back. So they're going to be in a far better situation than we know.
So, just think about this. Just think about this logically. Think about this practically. They're trying to choose between the lesser of the two evils. So, do they want to risk damage to the economy or do they want to risk a comeback with inflation? So, the Federal Reserve is more afraid of a comeback in inflation.
Now, I want to put a point in here that I think we're missing too. The Fed is not afraid of unemployment at this point at all. Again, they've raised rates 11 times to a 22-year high and have not affected unemployment at all. They're not at all concerned with how this is going to affect unemployment. They're really not that concerned about how it's affecting the economy. And frankly, I think they already know that it's not affecting inflation. That's just my opinion. Because again, the numbers don't support any of that happening.
And that is what is going to prompt the Federal Reserve to raise interest rates again. So we don't know whether that's going to be in November or December, but there's a good chance that it does happen. Is that a guarantee that it's going to happen? No, but there's a higher probability. So let me show you the current odds. According to the CME Fed Watch tool, at the November meeting, there's a 27% chance that the Federal Reserve raises interest rates. At the December meeting, there's a 40% chance, approximately a 40% chance, that interest rates will be higher than they are today, so higher than 5.5%. With you my opinion, I want to share with you how I see things playing out. On Wednesday, 2 p.m. Eastern Time, the Federal Reserve will announce that they are not raising interest rates. 30 minutes later, so at 2:30 p.m. Eastern Time, Jerome Powell, chair of the Federal Reserve, will begin the press conference. The theme of the press conference, so the theme is going to be data. Powell will say multiple times that their decisions will be data dependent. You're going to hear the word data about 10 times within 1 hour. That's my prediction. Now, I want to tell you this. The majority of what Powell will say, and he's going to go on for about 50 minutes, a little bit longer. The majority of what he will say is predictable and it's going to be very boring, I assure you. But there's going to be two very interesting things that we need to be paying attention to. So the first item, it's actually outside of Powell's press conference. So the first item is that this FOMC meeting, it's going to be a very special meeting. That's because at this meeting, the Federal Reserve will release their economic projections. So they don't do this at every meeting, but at this one, they will. That's why this one is a very special one. We want to see what their interest rate projections are. And this is going to give us their opinion of how high interest rates will have to go, whether it's going to be 5.5%, 5.75%, or 6.0%. They're also going to give us their unemployment rate projections.
And he's right. This is where he comes up with these projections for the future. But as far as his speech on Wednesday, yes, he's going to use the term data dependent. He's going to use a lot of different stuff. But it's almost not relevant what he says. It's almost more relevant how the market takes what he says. In fact, I don't even say almost, it is more important how the market takes what he says. Because there have been meetings where he's been exceedingly hawkish and the market is taking what he says as dovish. There have been other meetings where he's been, I would say, darn right dovish, and they've taken it on a hawkish tone, and the market has sold off. And I don't mean just for a day. And that's the other part to remember on Wednesday is to take into consideration it doesn't matter what happens to the stock market the day Powell speaks. What's far more important is what happens the day after and several days after, because you're going to have some real quick buying and selling and based upon algorithms and other stuff happening based on what he says. But the true test of what he says is what's happening over the next 2 weeks, not for one day. But I want to point out what he's talking about here, as I just said earlier. If Powell seems to think in these projections that he's going to have to raise the terminal rate and that he's expecting interest rates to be at this height or higher for an extended period of time, again, the market may not like that. The other thing is the unemployment. Now, I want to focus on that because he has continued to say they anticipate unemployment going up to 4.6 or whatever rate he's going to come up with based upon this data, which again, none of it has happened. So I don't know that even what he says about unemployment is relevant in reality. Now, the question is the market may take it negative. And again, they may take it negative for the wrong reasons. It doesn't really matter what he says because the truth is, and the reality is, what he's doing is making no effect on unemployment and is having no effect on inflation at all.
And other economic forecasts. The second interesting thing that we want to pay attention to is whether Powell comes off as dovish or hawkish, basically his delivery. We want to know if we basically want to know how strong or how stern or how serious he is about further interest rate increases. That's basically going to give us a clue.
Which again, I don't think that matters. What matters is how the market takes what he says. And going forward, my question on all of this from Powell is I don't think he needs to raise. And if he doesn't think he needs to raise, he's not going to tip his hand. He's going to sound like data dependent. We may have to raise, we may have to do other things. But it really boils down to one thing and one thing only. He wants inflation to get down to 2%. Okay. But you cannot get inflation down to 2% if shelter continues to be where it's at. And again, I'm not trying to beat a dead horse on this, but shelter is at 7.3%. And it's almost 40% of CPI. You cannot get inflation because it's part of core. Shelter is. You cannot get core inflation down to 2%. You cannot get CPI in general down to 2% if shelter is at 7.3. It's statistically not possible. It has to come down more. So what it really boils down to on this is how does Powell look at inflation? Is he looking at it as though the core products, again, excluding oil and food, but everything else, if he still thinks it's continuing to come down and he thinks shelter is going to come down, then he already knows he's done. He already knows he doesn't have to go any higher. Now, a lot of people are going to sit back and say shelter's not coming down that. It's coming down a little bit, but nothing like we thought. And we're going to see prices of homes come down from June to January like we do every year. But the question is the year over year number coming down enough? And when you look at shelter and it's at 0.3, is that going to be enough? And the answer is you just have to annualize it. It's really not that complicated. But when you've got in the rearview mirror a 0.8, 0.6, 0.6, that makes it very difficult to get the inflation number. So if we're going to be coming into 0.2, 0.1, and maybe start going negative at some point to run off these 0.8s, these 0.6s, it's going to take until February, March of next year to get rid of those numbers and get them off of the numbers for increasing. So to me, none of this is relevant. It all comes down to shelter, and shelter's not going to come down, and he doesn't think he can get shelter down. He's going to have to raise rates. If he thinks he can get shelter down without raising rates more, he doesn't have to. So I think what you're going to find on Wednesday, he's going to be very hawkish. He's going to, or at least try to be. He's going to be trying to be say he's going to be data dependent. And unless something weird comes out where things start going sideways and he thinks inflation is going to truly get embedded, I don't think anything's going to happen even in November or December, but I think he wants the market to feel that there is. He's going to want to continue that path. That's just my opinion. And I do think he's going to say that. So I think you're going to say, the question isn't what he even says. Again, long term, yes, we all know what's going to happen. We're going to get to November and we're going to be in the same position. We're going to go, is he going to raise? Is he not going to raise? We're going to get to December, the same thing. But the question for Wednesday and for the next several weeks is going to be, how does the market take what he says? What inflation is going to actually have to do? And how is it affecting the overall market? Which, like I say, personally, I look at shelter, and if models will hold, there should be a lag, and we're already seeing the numbers. We're seeing 0.3, especially if we see a 0.2 next month. If we see a 0.2 come out in shelter, I think it's already over. For some reason it jacks back up to 0.4, then I think it's going the other direction. We may have a problem. But this is the number you got to look at in my mind. It's all about shelter, and if shelter doesn't come down, he's going to have to do more. And or at least he's going to say he's going to have to do more. I don't think anything's going to do any of it. I think he just needs to stay where he's at, hold where he's at. And honestly, I think he's going to probably have to lower rates down quicker than everybody thinks, just because I think it's going to affect. I think the shelter effect is going to be a big one. And once that boulder starts coming down the hill, it's going to be almost impossible to stop. Now, I think on the CPI front, it's going to look a little different because you've got oil going into next year, which are low comps. So I think it's going to hold things together and make things not look as bad. But I do think down the road, when we come up to next year, when the comps on oil are about the same, and if shelter has really rolled over and maybe even go negative, that's where we could start seeing a problem where he's going to have to pull back. That's just my opinion. So talk to your financial advisor, make sure that your portfolio is set up for yourself so that you can retire when you want to retire, how you want to retire. Dickie out.